EM so far have gone at about 12 to 13% in global portfolios so far. Do you see the 2012 perhaps be the inflection point at which we are going to be looking at this allocation increase?
We don't tend to predict allocations of global funds into emerging markets. I think that's a tricky thing to forecast. I think what we can say is that there are some structural drivers which are going to be positive for emerging markets going forwards. I've mentioned a couple of these before. We have attractive valuation levels. We have a very good profile in terms of returns of the companies that we look at. And the combination of that, we think, will attract people towards emerging markets going forward.
Spoken about BRIC funds, but within the emerging market pack, it's almost like the two classes building. One is the BRIC countries which are explored and invested in, and then there are the frontier markets which are under-researched and being explored in terms of their opportunity. How are allocations being divided between the two so as to manage risk and return?
Within emerging markets, BRIC continues to dominate in terms of the asset class. Frontier markets is certainly becoming much more interesting. And let's not forget the other countries in between that are still very exciting for us, the non-BRIC, non-frontier markets. Ultimately for us at HSBC, it's not really a question of whether a stock is in the BRIC markets, not in the BRIC markets, or whether it's in the frontier markets. We want to investigate individual stocks. We want to buy individual stocks where we see value and where we see opportunity. And we're pretty agnostic as to where those stocks trade. I would imagine that in the future, increasingly, those could come from frontier markets. Today, to be honest, it's a very small part of what we do, partly because of the valuation set, which doesn't appeal to us as much as other markets, and partly also to do with liquidity. So we have to be very mindful of the lower levels of liquidity that we see in frontier markets. And I think until that changes, this can't be a huge opportunity set for us within the sphere of emerging markets.
So what markets are you bullish on or bearish on in the EM universe?
And again, these country views that we have are outputs from our stock views. So we've built our portfolios from the bottom up. But today we have particular long overweight tilts towards China, Russia and Korea.
Okay, what about Brazil?
Brazil, we've actually taken money out, so we've moved underweight that market recently, and that's not really a reflection particularly of the non-attractiveness of the Brazilian market. It's simply that we see more attractive opportunities elsewhere, and we've been funding that by reducing some of our Brazilian exposure.
Why is it that a lot of interest is now coming back into China?
I'd put it into there's two key issues for us. One is that the valuation levels of stocks in China have completely changed. So if we look at this at the market this time last year, we didn't actually think it was that attractive. We struggled to find cheap, exciting stocks to buy. But during the course of the year, as the market fell, this changed significantly. And the narrative of the market really changed. So investors were much more concerned about things like hard landings, which we started to hear about. Obviously, the property the property measures that have been introduced by the government were weighing on investor sentiment. And that really provided opportunities for us to go in and start to pick up stocks at what we consider to be attractive pricing. I think from a fundamental viewpoint, a big change that we've seen in the last few months has been the idea that some of these policy measures from China are starting to change. So we can see selective easing having happened, reserve ratio requirements have been cut in China, and I think it just points to policymakers understanding that they don't want to cause a hard landing in their own economy, and I think that's going to be very positive going forward.
So the risk that was there of a potential bubble in the real estate market or commodities because of the money supply that there was in the system has reduced considerably?
I think the risk was that China, by its own policy, was going to cause a big problem. There are still risks out there. The fact is that there has been a frenzy of property building activity in China, and I don't think we want to downplay that. But the fact is that the policy, which had tried to tighten and possibly over-tighten to focus on that, has now changed, and that to us is a positive.
Is it a call then that you're taking on oil because of the investment that you're making in Russia and the exposure you have in Brazil?
I would say the biggest call that we're taking in Russia is a valuation call. some of these companies are trading at exceptionally cheap valuations, even compared to their history, which again has been quite cheap. So we're pretty comfortable with that.
Omar, what's the view on India?
India's a market that we're really warming up to. So we spent most of last year underweight the market. We had some significant concerns. The market looked quite expensive to us. We were worried about some of the macro developments in terms of the politics and the current account deficit and its effect on the stocks that we look at in the universe. But really that's changed around a little bit in the last couple of months. And I mean, one thing is the market fell dramatically. Valuations have improved, so we can now find some stocks that we're interested in. And we've also seen a little bit of evidence that some of those headline worries are receding slightly in terms of the politics, the infrastructure spend, etc. We think we can see some improvements coming through.
You think that the earnings cycle perhaps would pick up from here now?
We think earnings for India, I mean, partly what's going to be important is the credit cycle that we've seen, and whether, especially for the financial sector, whether non-performing loans begin to cause an issue in terms of returns for those companies. But overall, when we look at the returns on capital that are being generated out of India, we feel relatively comfortable with those numbers.
What are your preferred themes in India right now?
Today we have three areas that we're particularly interested in: financials, commodities, and autos. And those are all quite different themes. The financials one is clearly a very domestic theme, and that's probably the area we've been adding most to recently, where we saw the dramatic falls and stocks became much cheaper for us. Commodities has been a bit more long-standing. It ties into the comments we made about China and the supply-demand balance there. And then autos is more of a stock-specific story, where we've seen some interesting companies which we think are looking attractive today.
But which segment of autos are you most bullish on?
Yeah, two-wheelers hasn't been a huge focus for us recently. In the past it had been clearly a very interesting area for India. Today we're much more focused on passenger vehicles and commercial vehicles.
What about the energy stocks in India? What about the energy sector?
Energy, we've had less exposure there, and we continue to have less exposure overall. Partly a reflection of where else we can obtain energy exposure in emerging markets. So we talked about Russia before. We can find what we consider to be much more attractively valued energy companies outside India in general.
What are you bearish on in India?
Some of the consumer areas look a little bit stretched to us. So again, I think we can almost widen this out, and it comes back to investors looking for certainty and gravitating to where they think it might be a safe haven. We don't see those as particularly attractive.
You spoke about infrastructure in China. What about infrastructure opportunities in India? We
think infrastructure in India overall is clearly going to grow, and there's a clear requirement for that to happen, and we hope that the government will help that to happen. But from an equity shareholder's perspective, we're not quite as positive. We don't necessarily see the returns for shareholders coming through in the way that we'd like, and we don't think the valuations have necessarily reflected that in all the cases yet. So that's still, for us, that's a wait and see.
Omar, the other bit that we observe over the last 15 days is the leadership that mid-caps and small-caps offered in this recovery for the market. What is your approach towards a broader, more liquid universe of stocks?
We're always very, very cautious in terms of liquidity. We want to make sure that we can trade the stocks that we have in our fund, and that naturally pushes us towards some of the more large cap areas of the universe in general. I'd say we're pretty agnostic as to whether companies are mid cap, small cap, large cap, as long as they trade. But overall the tilt in our portfolio today, particularly within India, is still to remain focused on the large caps.
Okay. What about IT stocks, given that we are now looking at the currency movement reversing itself, and that the expectation is that there will be more appreciation from here, and accounting for the problems in the US and Europe, what's your approach towards IT stocks?
As of today, we don't have Indian IT stocks in the portfolio. We haven't actually had them for a while. Ultimately, the valuations to us don't look particularly supportive compared to many of the other opportunities that we see in the market. And we don't see the return profile improving dramatically to be able to justify those valuations.
What about telecom?
Again, telecom hasn't been a big feature for us in India. So we don't have any telecom exposure, in fact, in the fund in India. At the moment, again, I don't see any huge changes coming through from a profitability perspective for those companies, that's going to make us more excited.
How come there is not that much mention of defenses such as healthcare and FMCG right now? Because if you are looking at managing volatility or in a high beta market, these are defenses that can help in mitigating your downside risk.
Yeah, that's a very good question, and I think the key is to do with valuation levels. And for us, risk can be defined in many ways, but ultimately the risk of capital loss comes if you enter a stock which is trading at a very high valuation. And when we look across emerging markets, we do see in general that many of these perceived higher safety stocks, higher certainty stocks, are actually trading at levels which to us seem not very viable going forward.
As we wind up, a quick sense of how you see India positioning itself by the end of this year. You think the second half for India would be dramatically different?
To be honest, it's very hard to predict what's going to be happening in the second half of this month, rather even compared to the second half of this year. So I'd hesitate to give a precise forecast of that. I think we live in a very volatile world. It's clear to see that things are changing all around us. What we can do as fund managers is to take advantage of the opportunities that we see to enhance our returns for our clients.
All right, Omar, we'll leave it at that. Thanks very much for taking out the time and speaking with us.